War in the Middle East, oil up more than 50%, a Supreme Court ruling that threw out the tariffs, and a news cycle that never stops. Now quickly, which one of those events changed the investment outlook for any of the companies in your portfolio? For investors, that's the only question that matters. This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. There's never been more information available to investors, and rarely has so little of it been useful. Politics takes up most of the news cycle. It generates an enormous amount of emotion, and most of the time, it has remarkably little to do with what your portfolio does. I'm not saying that politics doesn't matter. It matters a great deal. It just usually doesn't show up in corporate earnings. Here's the test, and it's the only one I use. Does this event change what companies will earn? Or does it just make me feel something? Last summer is a good example. The US bombed nuclear sites in Iran. The next day, the S&P 500 went up. Not because the news was good, but because investors couldn't draw a line from that event to corporate profits. Now compare that to April of last year, when the tariff plan was announced. The market fell nearly 10% in 2 days. Tariffs are a tax on imported goods. That's a direct hit to margins. The line to profits was short and obvious. Wall Street isn't callous, it's just literal. Let's be precise about what you own when you own a stock. You own a claim on a stream of future cash, and that's it. The value of a business is the cash it will generate for its owners over time, discounted for how certain you are that you'll actually get it. Think about buying a local business outright. If you're confident it earns $100,000 a year, you might pay $1 million for it. That's 10 times earnings, a 10% return. If those earnings look risky, you'll pay less. If they're growing, you'll pay more. Public companies work exactly the same way. There are just a great many more opinions involved. Run every piece of news through that filter. Will this increase future cash flow? Then values should move higher. Will it compress margins, raise labor or material costs, or reduce demand? Then values should move lower. Everything else is noise, which brings us to the argument dominating markets right now. Is artificial intelligence, and specifically the demand for semiconductors and data centers, a bubble? I'd argue that question misses the point. More than that, I'd argue it can't be answered. A bubble isn't a condition you can measure in real time. It's a verdict delivered afterwards. If the profits eventually justify the capital, we'll call this the greatest infrastructure build-out in a generation. If they don't, well, we'll call it a bubble, and everyone will explain how obvious it was all along. Nobody is going to hand you that answer in advance. But you don't need the answer. You need the evidence, and the evidence arrives every quarter in the same place it always does, earnings and cash flow. Look at what's actually being spent. Amazon, Alphabet, Microsoft, and Meta plan to spend more than $700 billion on capital expenditures this year, the great majority of it on AI infrastructure. Amazon announced $200 billion. Alphabet has raised its plan to as much as $205. Microsoft, roughly $190 billion. Meta, as much as $145. Last year, those same four companies spent about $410 billion. The number is up roughly 70% in a single year. Now put Apple next to that. Apple spent $12.5 billion on capital expenditures in the last fiscal year. Not $120 billion, just 12. Apple rents most of its computing capacity rather than building it and hands the cash back to shareholders instead. Two completely opposite strategies, and here's the part worth sitting with. Apple recently retook the title of most valuable company in the world, and then gave that title up with new concerns around, you guessed it, future cash flow due to weaker profit margins due to soaring memory costs. That is not an argument that the spending is wrong. Some of these companies have real evidence the money is coming back. Google's cloud backlog, contracts already signed, is enormous. Microsoft has more demand for Azure than it has electricity to serve it. It's an argument that the market does not grade capital spending. It grades expectations of future cash flow. And investors have started to notice the difference. Just last week, Alphabet raised its spending plan and reported accelerating cloud growth, and the stock sold off anyway, dragging the rest of the group with it. The tolerance for spending without visible return is thinning, and that's healthy. So what do you do with all of this? Track the earnings and cash flow, not the narrative, not the headlines, not anyone's hot take on whether we're in a bubble. Companies have to spend to build the future. A business that refuses to invest is just liquidating slowly. But there's a balance, and that balance shows up in the numbers. It's in the margins, in the return on the capital invested, in whether the revenue eventually arrives. That's going to take years to resolve, and you should be patient with it. But one thing is close to certain in the near term. Those capital budgets are already committed. Whoever ends up winning the AI race, the companies supplying the semiconductors, the storage, the networking, and the power to build it, are going to keep doing very well while it's being built. There will always be chaos. There's always another headline. The discipline isn't reacting faster than everyone else, it's knowing what to ignore. Ask the only question that matters. Does this change what these companies will earn? Most of the time, the honest answer is no. That's all I have for today. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.